Why shouldn't people be saving money in a bank account?
You gotta be crazy. I mean, look, they printed more money in the last, 5 years than ever in history. America is now the biggest debtor nation in history. Our debt to GDP a few years ago was 90%. Today it's about 125%. So the more they print money, the deeper in debt we get. So they increase the debt, right? And now we can't pay it off. And then they're going to raise interest rates into a recession. Now,
you work hard for your money, but is your money working hard for you? If you keep your cash in the bank, you're missing out on the opportunity to grow your wealth and secure your future. Cash is not only a low return asset, but also a high risk one, as it can lose its value due to inflation, currency fluctuations, or bank failures. And today, we will show you 6 alternative assets that are better and safer than cash or banks. Let's get into it. ETF investments.
this is God's money. This is what God's money looks like.
Yeah.
The reason I call it God's money is you can't fake it. You know, you can fake it with a fake ETF, like a gold ETF or a silver, which I don't touch because it smells as bad as the guys that printed that crap.
Imagine a world in which the money you have now will not buy you a cup of coffee tomorrow. This scenario, though extreme, paints a clearer picture of the ever-present risk of inflation, which reduces the purchase value of traditional paper currency. Throughout history, precious metals have constantly served as a buffer against such monetary deterioration. In human history, precious metals like gold, silver, and platinum have been prized for their beauty and their rarity, and value as a whole. These precious metals are a safe haven in difficult economic times because their supply is restricted by nature, unlike paper money, which governments can issue at leisure. Think of it like this. Before the 1950s, you could buy an ounce of gold for a mere $400. Today, that same ounce commands a price tag exceeding $2,000. This remarkable rise showcases the long-term appreciation potential of precious metals. Financial experts like those at Prime XBT even predict gold reaching a staggering $10,000 per ounce by 2032, potentially multiplying your investment 5-fold in just a decade. However, how can you take advantage of this potential if you don't want gold bars in your vault? This is where exchange-traded funds, or ETFs, come into the equation. With the ease and security that come with not holding real bullion, you can invest in precious metals like gold through these cutting-edge vehicles. Investing in an exchange-traded fund, or ETF, entails pooling your money with those of other investors to buy real gold, which is then held in safe custody by the fund. By doing this, you can profit from changes in the price of gold without having to worry about maintaining actual possession. Investing in precious metals, however, is not without its risks. Their prices can be volatile, influenced by factors like global economic conditions and supply chain disruptions. So before you get into it, you might want to conduct thorough research, understand your risk tolerance, and diversify your portfolio. If this is not your way, then you might want to check out land real estate. Wealth and property.
And so it was my rich dad who said to me, he says, you know, Robert, if you really want to be rich, learn to build businesses. It made more sense to him to work hard to build a business, something you owned and something you could pass on for generation to generation to your kids.
In the world of enduring investments, land and real estate stand out for their tangible and lasting value. Unlike precious metals secured in vaults, land is a non-depreciable asset, holding its value consistently. Essential for human progress since ancient times, land is integral to homes, schools, factories, farms, and commercial spaces, a resource increasingly scarce with a growing population. What distinguishes real estate is the land and the structures built on it. Residential homes, offices, and commercial properties provide indispensable shelter and spaces for thriving businesses, contributing to their perpetual demand. Like land, real estate serves as a robust inflation hedge. Housing prices tripled between 1992 and 2020 despite the 2008 housing bubble. While some view real estate as elusive, opportunities abound for all financial stages. Real Estate Investment Trusts, or REITs, offer an accessible entry point, functioning like mutual funds that pool investor cash for real estate management and acquisition. Established REITs like Ventas Inc. open avenues to diverse real estate industries, including healthcare. Strategic financial leverage and rental property ownership are viable options for those seeking hands-on involvement. Responsible investing, underpinned by thorough research and risk understanding, unveils the potential of real estate exposure at any point in your financial journey. Currency safety nets.
So you want to leave your job, but it's scary letting go of the security it provides. What you need to do is build a safety net and assess how high you need it to be. The purpose of a safety net is twofold. It catches you if all hell breaks loose and you fall off the wire, but it also gives you confidence to focus on your journey forward instead of the potential fall below.
In today's world of flat currencies, where money isn't backed by tangible assets like gold, choosing where to store your wealth can feel like navigating a financial storm. This is where safe haven currencies come in, offering a potential haven for your hard-earned money during times of economic and political turbulence. When searching for a safe haven, geopolitical stability is an important consideration. Take the peaceful and partial country of Switzerland, for example, and compare it to one that is experiencing instability in politics. Because of its strong economy and continuous neutrality, the Swiss franc is frequently chosen as a safe haven currency. For example, investors rushed to Switzerland during the financial crisis of 2008 and 2009.
2008 was a tumultuous year for the economy. The housing market collapse created one financial crisis after another, and it often seemed as if the news could only get worse. Here's a look back at the roller coaster that was our nation's economy in 2008.
Hoping to protect their investments from the market upheaval, the Swiss franc gained strength as a result of this surge in demand, enhancing its standing as a safe haven. Beyond Switzerland, other currencies like the British pound and Chinese yuan also hold safe haven status. However, the Swiss franc stands out due to its unique position. It even serves as a viable alternative to the US dollar for international trade. Remember the recent Russia-Ukraine conflict? When the US imposed sanctions on the Russian energy trade,
the US Department of State and the Department of Treasury released a sanctions list in connection with the Russian Federation's unlawful and unprovoked invasion of Ukraine, including facilitators of sanctions evasion.
Russia turned to the Swiss franc for transactions, driving its value up significantly against other currencies. In early 2023, a single Swiss franc even fetched more. Even while it might appear that only the very wealthy can create a Swiss bank account, lesser investors can still play the safe haven game. Solutions that are easily accessible include currency ETFs, exchange-traded funds, and Forex brokers like Forex.com. You may diversify your currency exposure with as little as $100, which might give your portfolio an extra layer of security during volatile times. Remember, diversification is critical. Combining safe haven currencies with other asset classes like precious metals and real estate can create a more resilient and well-rounded investment strategy. However, thorough research and understanding your risk tolerance are crucial before venturing into any investment, including safe haven currencies. But let's now look at industrial commodities. Commodities investment. Industrial commodities are the raw materials that fuel our modern world. Take silver, for instance. Its conductivity and resistance to corrosion make it invaluable in producing electronics, medical equipment, and even nuclear reactors. Similarly, metals like cobalt, nickel, and copper possess unique physical properties that are difficult to replace with alternative materials. This inherent demand drives their industrial value. Consider cobalt an important component in the lithium-ion batteries that power electric vehicles. Since 2020, the demand for cobalt has skyrocketed, driven by the global shift towards renewable energy. This surge in demand has translated into a remarkable price increase, with cobalt prices rising from $20,000 per ton in 2012 to $40,000 per ton in 2022, a 100% increase in just a decade. While the potential for substantial returns exist, investing in raw materials directly presents challenges. Large sums of money are often required, and storage and logistics can be complex. However, several avenues allow even smaller investors to participate in this exciting space. One approach involves investing in stocks of mining companies like Rio Tinto, a global mining giant. Another option is exploring mining-focused mutual funds that pool investor capital to diversify across various mining companies. Finally, for more experienced investors, derivatives like futures and options offer alternative ways to gain exposure to the price movements of specific commodities. Secure G-Secs. Ever wondered what this note is legal tender for all debts, public and private, on your dollar bill truly means? Since 1971, the US dollar, like many currencies, has been a flat currency, not backed by gold, but by the full faith and credit of the government. In simpler terms, its stability relies heavily on the government's strength. This very reliance is what makes sovereign guarantees, government backing, a valuable concept in investing. Why? Because a government's default is highly unlikely, as it would have dire consequences for the entire nation. So investing in government securities, GSECs like Treasury bills in the US, provides a safer way to store your wealth compared to traditional savings accounts. However, remember the 2009 Greek debt crisis?
Overseas now to Greece, a country on the brink of collapse. Banks shuttered, ATMs running out of cash, and now echoes in our country. Vacationing Greeks left stranded here penniless.
It's crucial to choose GSECs from stable governments with good credit ratings. In the US, you can buy Treasury bills, notes, and bonds directly or on the secondary market to gain exposure to this guarantee. While GSECs offer stability, their lower returns might not suit everyone. Seeking higher returns often leads investors to the stock market, where value stocks emerge as an option. These stocks, like those of companies dealing in essential materials, are considered less risky due to the consistent demand for their products. They typically offer steady price appreciation and consistent dividends, making them ideal for investors seeking stability and regular income. However, researching individual value stocks can be time-consuming. A solution for retail investors is dividend-focused mutual funds. These funds pool investor capital to invest in a diverse range of value stocks known for paying consistent dividends. This offers an affordable and efficient way to gain exposure to both stable companies and regular income. Remember, diversification is key, whether you choose sovereign guarantees, industrial commodities, or other options. Tailor your investment strategy based on your risk tolerance and long-term goals. Then there are the value stocks and mutual funds. Stable stock options. While Treasury investments like government bonds offer stability and slightly better returns compared to simply keeping your money in a savings account, their low risk comes with the trade-off of lower potential gains. This is where the stock market comes into play, offering the potential for higher returns for many investors who are comfortable with a bit more risk. The stock market isn't a homogeneous entity, however. It's broadly divided into two main categories: value stocks and growth stocks. Growth stocks, often associated with technology companies, tend to be riskier due to their focus on unproven ideas and emerging technologies. Their success hinges on factors that are often difficult to predict, making them potentially volatile investments. Value stocks, on the other hand, are generally considered less risky. These companies, like those dealing in essential materials such as industrial metals, cater to established demand, making them less susceptible to sudden changes in market trends. As a result, value stocks can offer two key advantages. First is the steady and stable price appreciation. Their value tends to increase gradually over time due to consistent demand and strong company fundamentals. The second is stable dividends. These are regular payments made by the company to its shareholders, providing a source of passive income. While researching individual value stocks to build your own portfolio can be time-consuming and require significant financial knowledge, there's a solution for busy investors: dividend-focused mutual funds. These funds pool money from multiple investors to invest in a diverse range of value stocks with a history of paying consistent dividends. A well-known example is the Vanguard High Dividend Yield Index Fund. By choosing such a fund, you gain exposure to multiple value stocks, benefiting from both potential price appreciation and regular dividend income without the extensive research required for individual stock picking. Remember, diversification is key to a successful investment strategy. Consider combining value stocks and mutual funds with other asset classes, such as sovereign guarantees or GSECs, to create a well-rounded portfolio that aligns with your individual risk tolerance and long-term financial goals.